SEBI has proposed 6 major changes to options trading, and it will impact all the options trader. Whether you are an options buyer or option seller, these rule changes definitely will impact you. So some of the highly impactful changes are increasing the contract size from 5 lakh 10 lakh to 15 to 20 lakh rupees, and limiting the weekly option expiry only for one exchange. So in this video, we will discuss what are these proposed changes for options trading by SEBI and why SEBI has decided to implement these rules, and my personal observation about these 6 new rules. So without wasting much time, let's start. These are the proposed changes. Number one, limiting weekly expiries. At the moment, there are 4 weekly expiries in NSE, right? Nifty, Bank Nifty, Fin Nifty, and Mid Cap, and 2 weekly expiries in BSE, that is Sensex and BankX. But as per the new rules from SEBI, any exchange will be allowed to operate only one weekly expiry contract. For example, NSE can offer weekly expiry only in Nifty or Bank Nifty, but not for both. Similarly, BSE can offer weekly expiry only for Sensex or BankX. Interestingly, SEBI has given NSE and BSE the freedom to choose the index for the weekly expiry. And friends, please note this change will be implemented in live from November 20, 2024. Right now, NSE has decided to offer the weekly options in Nifty, not in Bank Nifty, and BSE has decided to offer the weekly options in Sensex. There is a lot of debate is happening among traders for choosing Nifty for weekly option over Bank Nifty, because many traders are saying weekly options got introduced in Bank Nifty first in 2016 compared to Nifty in 2019, and also volume is very high in Bank Nifty. Because of all these reasons, they are saying it could have been better if weekly options were offered in Bank Nifty instead of Nifty. However, this debate is outside the scope of the proposed changes, right? Because SEBI has given the freedom for the NSE and BSE, and NSE has opted for Nifty over Bank Nifty. So in the future, weekly expiry is only available in Nifty as per NSE. Okay. Number two, increase in contract size. Currently, the contract size for index in F&O contract is in between 5 lakh to 10 lakh rupees. Starting from November 20, 2024, the contract value will be increased somewhere between 15 lakh to 20 lakh rupees. According to SEBI, this higher entry barrier could curb the speculative trading and promote a more efficient market. But personally, I feel this will only increase the volume of speculative trading. I will explain the reasons, and I will share my feedback for all the proposed changes once I covered all the proposed changes by SEBI in detail. India's number one stockbroker Zerodha has predicted the approximate lot size increase for all the indices. So as per Zerodha, Nifty lot increase from 25 to 60, Bank Nifty 15 to 30, Fin Nifty 25 to 60, Nifty Next 50 10 to 20, Mid Cap Nifty 50 to 115, Sensex 10 to 20, BankX 15 to 25. Friends, please note this is just Zerodha's prediction. We will get complete clarity once we get an official announcement from all the exchanges, especially NSE and BSE. Number three, additional margin on expiry day. In the future, an extreme loss margin ELM of 2% will be applied on option selling, but only on the expiry day to cover any potential risk due to the increased volatility. Friends, please note this ELM margin is only applicable for option selling and not for option buying, and it is available only on the expiry day and not on the available days, on the remaining days. For example, let's say you have a short position in Nifty 26,000 call option expiring on 30th October. Let's say the margin requirement for this is 1 lakh rupees. On the expiry day of this option, you have to maintain a margin of additional 2%. Friends, don't think that it is an additional of 2000 rupees over 1 lakh rupees, because ELM is calculated on the contract value. It means 2% of the strike price into the contract size. Now the contract size is, the lot size is 25, right? So 26,000 into 25, the 2% of this value comes around 13,000 rupees. So you need to maintain 1 lakh rupees, 13,000 1 lakh 13,000 rupees to maintain the same option selling position of Nifty 26,000 call option selling, right? Friends, please note this calculation has made with a lot size of 25. But going forward, let's say Nifty lot size increased to 60, then the same margin will come around 31,200 rupees approximately. Number 4th rule is no calendar spread benefits on expiry day. A calendar spread is a simple options trading strategy which involves buying and selling of option of the same underlying asset but with different expiry dates. There are many variations in it, okay? But in simple words, a trader sells short term option and buys a longer term option. Now, maybe at same strike price or different strike price. Now, as per SEBI, on the expiry day of futures and options contract, there is a higher chance that the price of the contract expiring will behave differently compared to those with later expires. So this happens because of the large trading volume on that day, right? So which can cause unpredictable price changes. Now, to manage this risk, SEBI has decided that the traders will not get any margin benefits for these calendar spread strategy from February 1st, 2025. Number 4th rule is upfront collection of premium while buying options. To ensure the brokers provide no additional leverage, SEBI has mandated that an option buyer now needs to pay the entire option premium upfront. So as of now, this is a normal with most of the broker as far as I know, and I don't think any broker who provides a margin facility for options buying at this point of time. Anyway, this doesn't impact much. The 5th rule is intraday monitoring of position limit. So this is to avoid monopoly from any individual, a big individual or a broker, and it will not impact most of the retail traders. So it's an existing rule already. SEBI and exchanges have limits on the maximum position a single client, a single trader or a broker can hold for a particular contract. For example, for a trader, this limit is set to 5% of the total number of derivative contracts of the same underlying, and it is 15% for brokers. So at the moment, the exchanges monitor these limits only after the market hours. However, from April 1, 2025, this will be observed multiple times throughout the trading hours actually. So these are all the proposed changes. So this is one short glimpse of all the changes proposed from SEBI. Friends, you might be wondering why SEBI came in and implemented all these rules, right? It all started with a zero DTE concept. So I will explain how it started because I'm observing the market, Nifty, Bank Nifty, and everything from many years, and I will explain how it got started. Before 2016, there were no weekly options in Indian markets. For the first time, weekly options got introduced in Bank Nifty in 2016. Before that, it's only monthly options. And most of the traders, 98-99% of the traders, they were doing only options buying, and option selling was not at all popular in India before 2016. Okay, now in 2016 weekly options got introduced in bank nifty, right? So there were many traders who picked the essence from the US market, especially the option selling essence, and they started to sell more the weekly options. At the same time, many strategies became popular, like the selling strategies, like the short straddle, short strangle, and especially the 920 short straddle strangle became very, very popular. So, a short strangle means, let's say Nifty is at 25,000 level. So, at 920, they used to sell 25,100 call option and 24,900 put option. So earlier, before 2016, even 2020, so markets were trading very rarely. For example, out of 100 days, market used to trade only on 20 days. The remaining 80 days, it used to display the sideways move. So whenever market displayed the sideways move, these traders were making profits. And if the market moves in one direction, for example, let's say it break the 25,100, in that case they used to lose the premium of 25,000 call option is started increasing, right? So what they used to do is book a stop loss for 25,000 call option, maybe for 1 is to 1.25 or 1 is to 1.5 stop loss level, and they used to push the stop loss level for 24,900 put option. So in this way, if the market displays the sideways move, they would have made the more profits. And if the market starts trending in one direction, either they would have made the break even or small profits or small losses, depending upon the stop loss level, whether it is 1.25 or 1.5, etc., or 2 times of the premium, etc. Now, weekly options got introduced in Nifty as well in 2019, and there were many traders started trading zero DT, which means we had Nifty, we had Bank Nifty, we had Fin Nifty on Tuesday. We got mid cap, we got Sensex. So because of all the weekly expiry on every trading day, so traders started implementing zero DTE strategies, which means zero DTE means, let's say Nifty is expiring on Thursday. So deploy that short straddle or short strangle strategy with different variation on Thursday. So Bank Nifty is expiring on Wednesday. Similarly, deploy these short strangle, short straddle strategies with different variations on Wednesday. So like this, on every trading day, we had one expiry contract, and traders started deploying these non-directional strategies on every day. So because of these availability of these weekly options contracts on every trading day, many traders they shifted to non-directional trading strategies like the short straddle or short strangle. And because of this, a lot of spikes started happening. There were many variations. People claim spikes happens because of the many reasons. I don't want to get into it, but my funda is very, very simple. Whenever the majority of the traders start to trade or start to use only one trading strategy, that strategy will lose the hedge actually. I will repeat once again. Whenever the majority of the traders start to deploy only one strategy, the edge in that strategy will go down. The same thing started to happen with these non-directional trading strategies. I will tell you what and all happened. Number one, let's say earlier one leg out of the money options were available for 20 rupees or 25 rupees on the expiry day earlier. But now it is the premium of those contracts, now it is not available for 25 or 30 rupees. In fact, it is available only for 10 rupees or 12 rupees. So because of this less premium, traders edge has gone down in this short straddle or short strangle strategy. Why? Because there is a juice, right? If for call option 30 rupees, put option 30 rupees, they used to get 60 rupees premium, and they used to keep stop loss at 1.5 level or 2 times of the premium. But now the premium is available only for 15 rupees, let's say another for 15 rupees. Now they're getting only 30 rupees profit even if the price displays complete sideways move. So which means almost 50% reduction in their profit. So this loses the edge because of this less premium. The edge will come down automatically. This is number one problem in short straddle or short triangle in the recent market condition. And number two problem is spikes. So for example, instead of spikes, I would say neutral day. For example, earlier, sideways day is one thing, and trending day. For example, if the market start to trend, it will trend. It used to trend only in one direction, either upside or either downside. But nowadays, in the current market condition, market opens here, it goes upside, it comes downside, again it will come closes here. So because of this, V shape on the upside, V shape on the downside, and again going upside, it it will hit the stop loss for both the call option and put option, the selling of call option and put option, and this results in a very big loss. So this is the second problem majority of the option sellers faced in their non-directional strategies in recent time. The third problem is spikes. Let's say I have sold a call option for 30 rupees. I have sold a put option at 30 rupees. I have kept a stop loss at 60 rupees. But on many occasions, price jumped, instead of it didn't execute my stop loss level at 60, it jumped and it went to 500 and 600 many times. So because of this option spikes, many traders, even many big traders who were non-directional traders, especially who are deploying short straddle or short triangle strategy, there is a huge loss. On many occasions, it wiped out the entire capital. So because of all these changes, SEBI decided to intervene and it implemented all these rules. Now let's go through what are all these rules and how it will impact the market. Friends, please note, this is my personal opinion, okay? My personal feeling, my gut feeling, personal observation about these proposed changes, and don't think it is fixed. Actually, it is going to happen like this. So number one proposed change by SEBI is limiting weekly expiry. Now we have 5 expiry and 5 trading days. Going forward, we have 2, Nifty and Sensex. So this is a big hit to zero DTE options traders. Okay, definitely the traders who used to deploy zero DTE trading strategies, definitely their number will come down. Okay, there is no doubt about it. So this is a big impact to option sellers. Okay, these numbers will come down. However, what they do is they will deploy one DTE strategy and zero DTE strategy as well. For example, if the Nifty is expiring on Thursday, so they will sell their strategies, short triangle strategies, even on Wednesday, one day before itself. So in this way, definitely some people will maintain their trade, but definitely this is a hit. It is a big hit for non-directional traders, and it is also a good opportunity for many traders to come towards the directional trading, because directional trading, if you are right, you can always make a good profit compared to the non-directional trading. So this is also an hit, and this is also an opportunity for traders to learn the directional trading. Okay, so number 2 is increase in contract size. I'm not really happy with this change because the current lot size in Nifty is 25 and they are saying it will be increased to either 50 or 60 going forward. And the current value is 5 lakh to 10 lakh rupees and they are saying it will be increased from 15 lakh to 20 lakh. So definitely, without a doubt, this is a big impact to option sellers, not for options buyers. I will repeat once again. This is a very big impact to option sellers and not for options buyers. Now, I don't understand how this will curb the speculative trading. Why? Because 95% of the retail traders, they do only options buying, right? The contract size doesn't matter to them. Let's say they were buying, for example, 10 rupees premium Nifty. So 25 into 10 rupees. They used to pay that amount. Now going forward, the contract size will be 50 or 60. So if now they opt for 50 into 10, because of this they might opt for further OTM position and still they lose money, right? So and some of the option sellers, who are beginners, who are not making money, they might come to options buying as well because of the huge increase in contract size. They may not be able to do the option selling and they will come to options buying only. So I don't understand how this step will curb the speculative trading. I feel this will only increase the volume of speculative trading. Once again, this is my personal opinion, friends. The third is additional margin of ELM of 2%. Once again, this is a direct hit for the option sellers on the expiry day, because on the expiry day they have to maintain 2% extra margin on the contract value. So once again, this is a direct punch to zero DTE traders. So I don't understand how they manage it, because of this. Definitely they can take only less position size, and because of that their edge will come down. So only one option I could think is they can shift to 1 DTE and close their position before the I mean uh, immediately after the expiry day, when the market opens on the expiry day, or close one day before only. So this is definitely a direct hit for zero DTE option sellers, and because of this I think some of the traders, the option sellers who are not successful or beginners, they might come to options buying as well, and this will only increase the speculative trading. So this is my personal opinion. And the fourth is no calendar spread benefit on the expiry day. So I don't think this will impact very much on the market, because very few traders deploy the calendar spread strategies in the market. And even because of this, what they can do is they will close their position on the expiry date. It's very simple. Or some of them, they roll over their strategy. So I don't think this will have a huge impact on the trading community. So the fifth option is upfront collection of premium for options buying. This is a decent current norm with most of the brokers. Even in Zerodha, you need to keep the entire premium value while buying option. I think this is the standard for with most of the standard brokers. So there is not much impact because of this rule change. So the sixth one is intraday monitoring of all the positions. So this is currently it's happening at after the market hours. Now it will happen at intraday level. So this is applicable only for the big traders and brokers. So this will not have a huge impact, in fact, it will not have any much impact with normal retail traders. See friends, these are all the proposed changes from SEBI, and this is my personal observation for these changes from SEBI. So do you think it is useful, friends? If yes, you can like the content, you can share the content and subscribe to my channel. See you in the next video with another useful content. Thank you. See you. Bye bye.